Here again with Smart System. In our last lesson, we began our discussion on monetary policy, with a look at one of its key components, and how it relates to trading interest rates. In today's lesson, we're going to continue our discussion on interest rates, and introduce the institution that's responsible for implementing monetary policy, the Federal Reserve. So let's get started. As we saw in our example yesterday, small movements and interest rates can have dramatic effects on the economy. Just a small changes in interest rates can dramatically increase the cost for individuals to own a home or borrow money to purchase other goods. They can also have a dramatic effect on the cost of doing business. For this reason that when interest rates rise, making borrowed money more costly, that people also be less likely to start or expand a business. This not only has an effect on the business person themselves, but filters throughout the entire economy, as less businesses being started. Expanding and expanded means less jobs, which means less people getting paychecks, which means people spending less money, and etc. there. The reverse of this is also true. For when interest rates fall, and business owners take advantage of access to cheaper and borrowed money, and you should see the stock market react accordingly. They are all else being equal. In addition to interest rates affecting the stock market, interest rates also have a direct effect on the bond, foreign exchange and futures markets. Here are a couple quick examples of this, which we'll expand on later lessons. When interest rates rise, when looking at the bond market, the value of existing bonds fall as investors can now purchase the same bond with a higher interest rate. And the reverse is also true there. In the foreign exchange market, when interest rates rise, it becomes more attractive from a yield standpoint to earn the dollar against other currencies, or to invest in interest-bearing dollar-based assets. This normally creates a demand for dollars, which will many times cause the dollar to strengthen. And the reverse is also true. When interest rates fall normally, in the commodities markets, when economies grow at a greater rate, as a result of lower interest rates, this is normally going to mean greater demand for commodities, so their value will tend well. The value of things like oil and things like that will tend to rise, and that's important to traders of those markets. We're gonna get into more specifics on each of these examples in a series of lessons, which will be devoted to individual markets. So if you don't understand this part, don't worry. At this stage, I'm simply giving these examples here to help further demonstrate the effect that interest rates have now that we understand the importance of interest rates to economic growth, and therefore the markets in our own trading. The next thing to understand is how this relates to our discussion of the government's role in the economy. As we've learned in previous lessons, the government has two options when trying to influence the business cycle: to keep prices stable and work towards full employment. The first, which we've already discussed, is physical policy, or exerting control over government spending and taxation to try and influence the business cycle. The second, and perhaps most important to us as traders, is monetary policy, which is exerting control over the money supply, which has a direct relationship with interest rates, also with the goal of influencing the economy and the business cycle. With this in mind, the Federal Reserve, or Fed, as it's often called, is the institution responsible for administering monetary policy, therefore can increase or decrease the money supply, with the goal of trying to affect the level of interest rates in the United States, as the level of interest rates has such a large effect on everything in the economy, from unemployment to inflation. This makes the Fed one of not the most powerful institutions in the world. And you can see here in this picture, for those of you who follow finance a little bit, I should recognize Alan Greenspan. They are the former chairman of the Federal Reserve, and Ben Bernanke, chairman of the Federal Reserve. We'll get into talk a little bit more about them. So in next lesson, we're gonna learn a little more about the Fed and some of its key players, so we can begin to have a better understanding of monetary policy and how we as traders can profit from this knowledge. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.